What's going on, guys? It is the 21st of January, and well, yesterday was a hell of a day. Had the inauguration of a returning president, an enormous amount of signatures, changing things that were put in place, with another stack of signatures done 4 years ago. And those stack of signatures, we're all going to, I would say we all are. There's going to be a few of us that will debate on which was better for the economy, better for us as human beings, better for just us as a social order, all those things. I personally am much happier with the stack of signatures this year than I was 4 years ago. The ones 4 years ago, all it did was allude to an enormous amount of inflation, enormous amount of debt for our country, and then of course just the amount of currency that was going to go into circulation was just insane. And we saw that. It's not like that was hidden whatsoever. What's interesting is the commentary that we get on it, and the supposed benefits of it. And I think the benefits went to individuals, not to us as a whole. So that's just going to be my opinion. Again, most of what I share on here is opinion, just comes from experience, things that I have experienced. And one of the main things we want to get into, of course, is what's driving interest rates, what affects you, the real estate investor, when it comes to interest rates. Now, the main reason I've been getting interest rates, because first off, Aaron Chapman's opinion, they don't freaking matter. All it is a number you use to calculate out the end expense on an asset that you are looking to acquire. And when you acquire that asset, you're going to put up a portion of the capital to acquire this. Maybe not, depending upon the type of deal you do. There's deals out there that we can talk about that you may not have to have a lot invested. Then you have what the bank will put in, my organization will secure or put together for you so you can have that third party put that capital up. Now you've been able to secure an asset that you control. You have somebody completely unrelated that comes in and pays off your partner, which is the banking entity, over that 30-year period. And the longer that you take to pay, the less you actually pay because you're paying it back with a diminishing instrument like the US dollar. If that is something you don't understand, if you've never heard of the 30-year fixed mortgage being a hedge against inflation, if you've never been told don't pay off your mortgage early, if you've never been told don't get an ARM, don't get a short-term deal like a 10-year or a 15-year, then you probably should talk to me. If nobody's ever told you that, and everybody has said, do not do this. I'm talking to you. I mean, this is a stern statement. Do not listen to those people who say, get an ARM, get a 15-year, get a 10-year, pay extra on your mortgage, do the debt snowball. I'm telling you, do not do that. There's a reason. Now, I'll tell you what the reasons are, then you evaluate for yourself, decide whether or not that makes sense. This again, Aaron Chapman's opinion, but I'll bring the receipts to back it up. This is something we need to have a conversation about. Another thing you need to do, if you're going to be a real estate investor, you need to be prepared to be putting together LLCs in the area where you're buying the real estate, and another LLC for a completely separate purpose, which I will share with you. I'm also big into family trust. I have a family trust that holds everything. Again, I'm not an attorney. I will just share you what I've seen people use them for, how they're applied for a real estate investment business, and how they've used to grow their business. You're the CEO of your real estate investment, your real estate investment business, you decide for yourself. I am not telling you what to do. I'm giving you things to think about. If I can't make you think, I'm useless. If your lender, your real estate agent, your CPA, your attorney, anybody can't make you think, they are useless. You need to be expanding what your mind has in it. And if that doesn't do that, all I do is quoting rates, saying we can close on time and we have cheap costs. That's all they are. A cheap object. They have zero value to you because anybody can do that kind of crap. We need to think, how do we use this to your benefit? Now, let's talk about what's going on in the market. Interest rates, market, all of that's driven by what? Emotion, period. There is people behind the movement of this money, whether it goes into stocks, to bonds, to precious metals, to currencies, into whatever form of investment, real estate, you name it, whatever type of commodity is out there, that is based upon the belief of all that's happening around that person and where they believe they can put their money to make more money. Where is it going to grow and have the best ability to grow with the least amount of risk? Nobody wants to put it out there to lose it. It's an amazing amount of people out there throwing money out there and praying it's going to work. but not taking the time to make sure they've mitigated the risk. And this is what I help you do. What my job is to point things out. You still make a decision. I don't tell you what to do. Now, when it comes to interest rates, that's derived by where do they believe those who are putting money out there, large hedge funds, whichever, do they believe they're secure, more secure in the bonds, which is where mortgage-backed securities are at, which is where your interest rates are derived from, or in the stocks where we're seeing an economy grow. Now, because of all the actions that we've seen over the last few years, we've seen enormous amounts of inflation. Because of that enormous amounts of inflation, mortgage-backed securities have taken a beat. Interest rates have gone up. But also because of that which created the inflation, which is quantitative easing, that's why we even had the low interest rates to begin with. So let's take a look at this snapshot. So this is the Fannie Mae, or the UMBS 5.5 coupon. It goes all the way back to August of 2026, if you can see this. Now, I have two lines drawn here, a blue one and a red one that is vertical, two vertical lines. They represent the week of November 25th, I believe it was, 2008, when they announced quantitative easing, when the Federal Reserve came out. Ben Bernanke, who was the chairman of the Fed, Hank Paulson, who was the secretary of the Treasury, says we're going to start quantitative easing to stimulate the economy, which means we're going to print money out of thin air, we're going to run it through the Federal Reserve, and they're going to invest in these securities for us. Now, before that, investment in these securities actually were down below these lines, similar to where we are today. Once the Fed announced this, it jumped to the effect of this block. I'm going to zoom in on this block for you guys to see here. It's going to be a bit of movement here, and I apologize for all the movement, but it's necessary. So this block represents 1 day's trading, the day that they said it opened and then it closed. So when they said we're going to start quantitative easing and when they ended quantitative easing, all happened in this 1 day block. Then they actually started quantitative easing, represented by this week of the 29th of December is actually the 2nd of January. It was represented that week. These are only 1 week candles here. I'm not showing you full day candles because it's a bigger chart. And that's where this line starts. That's the actual value of the security after they start putting money in from the federal side of it. This is the value of the security prior to them putting money in on it. This was the value of the security in this shaded area of the full day of trading that they announced putting the money in it. Now what we do is we zoom back out and we look here. This is everything above this line was with the federal government putting money in, $8.9 trillion going into market during this window of time. You get to this area right here, October 2021 is when they start quantitative tightening and say, we're no longer going to put money in. And it fell off a cliff because there was no more flow. So when it comes to interest rates are derived by a supply and demand of money. Greater supply, lower the demand, lower the interest rate. Higher the supply, so the lighter the supply or less money in there, and the higher the demand, the higher the cost goes. It's like going to you're walking to the auction house with 200 people, and you're all bidding on one item. Pretty expensive item, right? What if there's 200 of you, 200 of you on one item, that's expensive item. Well, there's one of you and there's 200 of the same item. You'll probably get that item really cheap. They'll probably give you 5 or 6 of them, get most of it for free. That's what we're talking about here. Tons of money in there, not as many people buying. Now, a lot of people wanting to buy. There's low inventory, not as much money. That's what we're staring at. So that's what's driving our interest rates. We saw in the last 48 hours, interest rates actually have done well with some of the readings that have come out. This is a different version of the exact same chart. We come off of our lows, come up higher. Now, I for some reason can't put my lines in there to show you where we are because these today and yesterday, till today disappears actually. So the 21st will disappear on that, and I'll just show you. If I put my chart lines in here so you can see what I'm talking about. And take a look right here. 21st has disappeared. Not there. So now we're showing the 20th, which was yesterday. Actually, I'm even seeing 17th, which was Friday. We're not seeing that trading at all. But we're right in this area here. We're bouncing off of this line right here, this ceiling. Again, here's that same value from trading back in 2008. That's our big ceiling. That's going to be hard for us to get above. See, look at when we took that major plunge after quantitative tightening, and we couldn't really get above those areas. Those are our ceilings. That's where our interest rates are going to remain. I don't believe we're going to get better rates than that. So if you're sitting on the sideline saying, well, the rates can do better. I'll buy houses when the rates get better. They're not going to get better by much. You might as well get in the game now. The only thing that's going to happen if rates drop a lot is houses will go up in price. You're going to pay more. One way or the other, you're paying more. So you might as well get into the game now. Start evaluating your real estate. Start evaluating what the cost will be because of the rate you have. Not shopping it around. That's such a waste of time. Do what you want. But it's a real waste of time. I'll explain why. We're here with our experience, a large team to guide you through. I've seen other people fail and other people succeed. We can give you practical data, not speculation theory. So I will talk to you guys when you call. Just go to the website, aaronchapman.com, or text me 602-291-3357. Appreciate you.